We're a distressed buyer of real estate. So we're looking at value-add opportunities mostly in secondary and tertiary markets. So we're really away from the crowd because most of the crowd's in the primary markets and all the gateway markets, and we're not there. So we're in markets that no one wants to be in, and we're also dealing with assets that are typically the hardest to do. They're physically distressed, they're certainly distressed from a financial perspective, and they're distressed from a management perspective. So when we get something, everything's wrong with it. Based upon the nature of the acquisition, it could be anything from a repositioning from a management perspective and a financial perspective in terms of the capitalization to, again, the example of Riva, which is a major construction renovation along with the repositioning of the asset itself. You know, what we typically see for us is when we take over assets, it was a function of sponsor risk. And the people that were involved candidly didn't have the capacity financially to do what they were doing, and they probably didn't have the organizational or ability to do what they were doing. So by the time we see it, by the time we get it, everyth's wrong. Yeah, Riva is a great example of a classic deal that we do. It was a fractured condominium. We bought the debt post-bankruptcy, and when we walked in, we acquired about 75% of the units. We had to then subsequently acquire the remaining 25%. It took us about 2.5, almost 3 years to do that. We bought the deal post-Lehman Brothers as the market was collapsing. And we then spent the rest of the time working with essentially special servicers on behalf of the mortgage lenders that were involved in foreclosing units. We would buy them from them, and it took a while to do that. As I said earlier, it was a very complex process to do that. And then we hadn't started the renovation until we were able to assemble all the units. We've done that now. We've completed a very extensive renovation. We spent about $2.2 million on the exterior. Yeah, I mean, for me, the session was very enlightening. You know, we're clearly totally at the opposite end of everybody else who was up there. I mean, the investors and the buyers that were involved in the presentation were looking at gateway markets. They're looking at cap rate compressed markets. They're looking at buying and chasing deals at very low cap rates. And you know, we're out in the tertiary markets doing significantly riskier value-add deals. Our returns are certainly risk-adjusted, and you know, quite significantly greater than what they're able to get in those primary markets. So it sort of validated my theory, which is most of the people are not where we are, which from our perspective is a good thing. There's a significant amount of busted deal flow coming in 2012, 2013, and 2014. And candidly, you know, I'm actually quite happy that most of those people are not in the same markets that we're in, chasing all the assets that we're involved with.